Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, Christine Benz gives us financial tasks for February, Preston Caldwell forecasts the pandemic's long-run impact, we highlight a sector with little risk of dividend cuts, and Russ Kinnell screens the 10 highest-yielding funds in the Morningstar 500. Let's get started. Christine Benz and Susan Jabinski from Morningstar Inc. discuss financial to-dos for February.
Hi, I'm Susan Jabinski with Morningstar. Morningstar's Director of Personal Finance, Christine Benz, has created a month-by-month financial to-do list for 2021. And she's here today to talk with us about what should be on our to-do list for February. Hi, Christine. Thanks for being here.
Hi, Susan. It's great to be here.
So the first task you recommend that we sort of check off our list for February is to do an investment review. How would someone go around doing that?
Right. The idea here is that you want to check on the characteristics of your portfolio today. One thing I would say, Susan, is that if people went through this process at the end of 2020, there's no need to get back in there and redo it. But if you've been one of the many investors who's been feeling a little bit inert or complacent about your portfolio, you've been kind of letting your winners ride, I think it is a time to take a closer look at your portfolio's asset allocation. Maybe some of the market volatility that we've had very recently would be kind of your impetus to do that. And basically, you want to check on your portfolio's current asset class exposures relative to whatever target you have for them. And we've had such strong equity market performance that for many of us, our equity holdings may be a little larger than our target, and that's particularly important if we're getting closer to retirement. So check on that. I like Morningstar's X-ray functionality to help with that job. Check on your exposure to safer assets. If you're a younger investor where you've got the bulk of your portfolio in equities, the key job you want to tackle is looking at your intra-equity exposure. One recommendation I would make to many people at this life stage is to check their foreign relative to U.S. exposure. We've had better performance from U.S. stocks, but when we look at what market forecasts look like for the next decade, there's the widespread expectation that foreign stocks will perform better than U.S. in the decade ahead, in part because of lower starting valuations. So check out those asset class exposures as a starting point.
And then do you recommend that investors look sort of beyond their asset allocation? What other factors might they be looking at in an investment review?
They definitely should. So if you have time, if your schedule permits, delve a little bit more deeply. Look at your stock exposure, individual stock exposure. Many investors hold side portfolios of individual stocks as well as mutual funds. In X-ray, you can check out how your portfolio is exposed to some of those big cap names that dominate many mutual funds. If you also hold them individually in brokerage accounts, you may have more exposure there than perhaps you expected. I think it's a great time to look at the expenses that you're paying on your holdings. The expectation is that market returns will be pretty constrained over the next decade. So one of the best things you can do to improve your take-home returns is just to lower what you're paying in fund fees. And thankfully, investors seem to have gotten the message on that front. But take a look at your expense ratios. Also take a look at the tax efficiency of your portfolio. If you have your assets in multiple silos, as many of us do, you want to pay special attention to your taxable account just to make sure that you are managing that account with an eye toward reducing the drag of taxes on an ongoing basis. Equity exchange traded funds are a great way to keep your tax costs down. If you're a bond investor, especially if you're a higher income bond investor, municipal bonds may make sense. So do a little bit of a tax audit as well if your schedule permits.
And speaking of taxes, those tax documents are starting to roll in. You say now is a good time for us to start to gather the documentation that we will need for filing our taxes. What are some things we should be aware of?
One of the key things I would think about as I sort of start this process of tax season is think about whether you're likely to be an itemized deduction person or whether you'll take the standard deduction. One thing we've had for the past few years is a very high standard deduction. Many fewer taxpayers are itemizing than in the past. In fact, I think the most recent data pointed to just about 15% of taxpayers itemizing today. But nonetheless, that's still a healthy share of our population. If you're not an itemizer, that means that you don't have to gather up all of those documents that you would need to support your itemization. So you wouldn't have to worry about the healthcare expense documentation, the charitable contribution documentation, and so forth. But if you are an itemizer, you'd want to get serious about collecting those documents. One thing I want to flag with this tax season for the 2020 tax year, Susan, is the fact that we have a special $300 deduction that's available for charitable contributions in 2020. That's available to taxpayers whether they are using the standard deduction or itemizing. So even if you are taking the standard deduction and you made charitable contributions last year, make sure that you're taking advantage of that admittedly small deduction.
Now, you've talked in the past a little bit about how our 1099s and W-2s can actually yield some really interesting financial information. Let's talk a little bit about that.
Definitely. So W-2s, starting with that, I would say, don't just put them in the folder or plug them into whatever sort of software you're using for your taxes. Actually take a little bit of time to gather some intelligence from them. You want to keep an eye on salary trend. And for many people, 2020 was not a great year in terms of income. Lots of people had income disruptions, but you want to keep an eye on salary trend from year to year. But also take a look at how you took advantage of any contributions that you were able to make through your company retirement plan. So check into whether you were able to fully fund your 401k or whatever retirement plan that you have available to you in 2020. Also check if you are covered by a high deductible healthcare plan and you're using the company provided HSA. Check to see if you were able to take advantage of that as well. And those are pieces of information that you'll find on your W-2. In terms of 1099s, there I think investors can gain a lot of intelligence about how they are managing their accounts. So they can see if they are paying hefty levels of income, of tax on income in taxable accounts. Can they maybe make some changes to their asset placement? So can they get those higher income, I should say, investments into tax sheltered accounts? Also take a look at if you've got mutual funds in your taxable accounts, were you paying high levels of capital gains because the funds were making distributions? One point I've been making on that in that area is that investors who have these serial capital gains distributors in their taxable accounts, they've been kind of prepaying taxes as they've gone along. So the tax hit associated with moving those assets, moving into a more tax-friendly investment may be a little less than you bargained for. So check with an accountant on that, but you may have been effectively prepaying the taxes that you would owe if you sell that investment and swap into something that's more tax efficient.
Well, Christine, thanks so much for some financial to-dos for us in February. We appreciate your time.
Susan, thank you so much.
I'm Susan Jabinski with Morningstar. Thank you for tuning in.
Expand your investing horizons and look to the long term with Morningstar's podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Now, Jake Van Kersen from Morningstar Inc. interviews Preston Caldwell from Morningstar Research Services.
COVID-19 caused major changes in how we did everything. But how many of those changes from 2020 are here to stay? Well, we're not going to be able to tell you the future, but we can take a look to the past for some guidance.
Well, first off, we wanted to create a framework for how a disruptive event like COVID-19 could impact the economy and society in the long run. Most people take it for granted there will be such an impact, but we wanted to be precise in our thinking. So we identified 3 specific causal channels for the pandemic's long-run impact. First, habits could change during the pandemic as people get used to doing less of certain activities like eating out, and that could cause lasting changes in consumer behavior. Second, fear of the next pandemic could make consumers reluctant to engage in activities involving a high degree of social contact. Third, sunk costs incurred during the pandemic could change the long-term economic calculus of consumers and firms. As a concrete example of sunk costs, retailers' increased investment in e-commerce capabilities during the pandemic could have a long-term positive impact on the online shopping experience for their customers. With this framework in hand, we analyzed several historical episodes. In selecting these episodes, our goal is to understand, in general, what happens when the economy is perturbed by an extreme but temporary external shock. Pandemics are one type of this class of events, but so also are wars, political upheaval, and other disruptions. We look at this broader class of events rather than just strictly pandemics, and this makes us different from any of the other research out there that I've seen.
So the first event you looked at was World War II and how that caused disruption in the UK supply chain, which led to nationwide rationing.
Rationing in the UK was severe, affecting many commonly used items like butter, meat, and gasoline, and lasted to some extent for the better part of a decade. Why is this an informative episode for today? It provides a clear example of people being deeply deprived of goods for several years for reasons outside their control. So this is somewhat analogous to the situation today of people being deprived of consumer services because of social distancing needs. Did consumers' habits change? Did long-run consumption of rationed goods remain depressed even after people regained access after the war? Our analysis says no, wartime rationing didn't have a large long-run impact, as demand for rationed goods generally mounted a full recovery after the war.
Now, 2020 was a time in which we all went home to work, but we often think of World War II as a time when many women left the home and went to join the workforce.
Indeed, one other historical episode in which people drastically changed how they worked was the surge in U.S. female labor force participation during World War II. However, many of these women left the workforce after the war ended. And while certainly U.S. female labor force participation did steadily climb throughout the 20th century, it doesn't appear that World War II itself did anything more than modestly accelerate this pre-existing trend.
Moving a little further down the road, the oil price shock of the 1970s caused a temporary period of very high oil prices, which naturally cut into the demand. Yet when the prices did come down again, the demand never really jumped up to what it was before, right?
Right, so with a conventional economic model, you'd expect that once prices went back down, consumers would go back to their prior consumption levels, but that didn't happen. One reason is that it appears the oil price shock catalyzed a long period of fuel efficiency improvements due principally to new technologies, and these fuel efficiency gains didn't reverse once oil prices eventually fell in the late 1980s. Tying this back to the framework I mentioned earlier, this would be an example of the sunk cost channel. Those fuel efficiency improvements wouldn't have been generated in the absence of that temporary oil price shock, but because they were sunk costs, for example R&D that had already been spent, they had a lasting impact after the shock had passed.
9/11 understandably had an impact on air travel. What were the long-term effects of that?
U.S. air travel was down for several years owing to the fear created by 9/11, but this fear eventually faded, and by the late 2000s, air travel essentially fully recovered from the impact of 9/11.
Of course, COVID-19 is not the only pandemic we have seen. What are some of the other major pandemics, and what impact did they have?
Well, even some of the more noteworthy pandemics in recent history, like SARS in the early 2000s, didn't have a big impact even in the short run. So these episodes aren't really good guides to the long-run impact of COVID-19, which clearly has had a massively disruptive impact in the short run. That's why we opted for a different approach, looking at other kinds of events like wars, which, while not strictly pandemics, had a short-run impact on society much more akin to COVID-19.
Well, Preston, taking a look back at these events has been fairly heavy. Still, given that you have taken such a high-level look at them, do you see any upshot for us coming out of this moment in time?
Well, there's little support for the idea that a change in consumer habits or lingering fear will reshape the post pandemic economy based on these historical episodes. Now, that's not to rule these factors out because this is just one way of looking at the problem. But at the very least, we should think carefully before we proclaim a new normal in the world after COVID. And if there is a reshaping of the post pandemic economy, sunk costs appear to be one of the more credible channels. So, for example, these e commerce investments that retailers are making, or the experimentation by new online shoppers, are sunk costs which could cause lasting changes in e commerce adoption even after the pandemic. By contrast, if we look at the idea that eating out in restaurants will be permanently lower or that air travel will be permanently lower, those would seem to rely heavily on changes in habits or lingering fear. And again, based on this analysis, there isn't a lot of support for that notion.
Thanks, Preston. While we don't know what lies ahead, looking through the rearview mirror can give us some idea of the way forward.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Next, we share why independent refiners look attractive.
With the rollout of a COVID-19 vaccine underway, we think there is light at the end of the tunnel for independent refiners. Although we expect that an economic recovery is likely to begin in 2021, an improvement in refining market indicators, such as inventory and utilization levels, is likely to lag. That could keep a lid on margins in the near term. Ultimately, however, we see petroleum product demand recovering toward pre-pandemic levels, normalizing inventory and utilization levels, and lifting refining margins toward mid-cycle levels. The equity markets continue to price shares of independent refiners as if margins will not recover, which is keeping dividend yields near historical highs. We see little risk of dividend cuts, thanks to large cash balances and improving cash flows. As a result, refiners continue to present an opportunity as a play on economic recovery. Given that all refiners appear relatively cheap, we'd lean towards quality. Of the refiners we cover, we prefer Valero, given its superior assets and dividend safety. A rising tide of improved product demand, lower inventory levels, and higher margins will lift all boats. But as a pure play refiner with the highest quality assets, Valero stands to benefit while offering protection in the event the difficult environment persists for longer than expected.
And lastly this week, Russ Kinnell from Morningstar Research Services tells us which funds balance yield and risk better than others.
Hi, I'm Susan Jabinsky with Morningstar. Given the current low interest rate environment, many investors are scrambling for yield. But screening for funds based on yield alone can be risky. In the latest issue of Morningstar Fund Investor, editor Russ Kinnell takes a look at high-yielding, highly rated funds, and he's here today to share his findings with us. Hi, Russ. Thank you for being here.
Hey, good to be here.
So you specifically screened on the 10 highest-yielding funds in the Morningstar 500, and the Morningstar 500 is a list of some of the biggest and highest-rated mutual funds that Morningstar tracks. What are some of the general findings from that exercise?
Well, I think generally it obviously takes you to funds that are taking on significant amount of risk to get a yield. And in today's environment, you have to take on a fair amount of risk to get a decent yield. Even though we had an interest rate spike early in the year, as the economy stabilized, interest rates became quite low. And so you do have to take on a fair amount of risk, and you certainly want to appreciate that going in. If you want to return your portfolio to income levels of the past, recognize that doing that may well mean increasing risk. But I think you can do so if you're diversified and careful. You can do so without too much risk.
So there were a couple of different fund categories that came up more than once in this list. The first being high yield corporate bond funds. And the three funds that were on the list specifically were Hotchkiss& Wiley High Yield, T. Rowe Price High Yield, and Fidelity High Income. So let's talk a little bit about some of the risks of high yield bond investing in general, and then how these funds have managed it a little more specifically.
Sure. Well, you can start by just going back a year ago to the first quarter of 2020 and seeing in the COVID sell-off, all three of these funds lost between 22 and 23% of their value. So it's really clear that this is a group that's very economically sensitive. Of course, high yield means you've got companies with a lot of debt. And if you have a lot of debt and the economy goes south, all of a sudden things look risky. So that's what happened. But then the rest of the year, those funds all rallied to actually manage to get slightly in the black. And I think that illustrates, the risks and the appeal there, that there is significant risk. These are well-run funds. All three of them are medalists, but you're still taking an amount of risk, and you have to appreciate that going in.
Another category that came up more than once was emerging market bond funds. The three funds specifically were PIMCO Emerging Markets Local Currency and Bond, T. Rowe Price Emerging Markets Bond, and Fidelity New Markets Income. So again, let's walk through some of the risk return payoff with those particular funds.
That's right. I think emerging market bond is even another level of risk beyond high yield. So definitely tread carefully here. Don't make it a big part of your portfolio. But what's interesting there is that we have three well-known shops, firms we really like, have a lot of good bond efforts, yet all three funds are neutral rated. And the reason is it's hard for even those firms to find the right mix of strategy and people. And in all three cases, they're a little bit in flux because it really is a hard thing to do. Emerging markets have been a place that have regularly gotten smacked, and so it's a pretty treacherous area. But at the same time, there are good yields. There's good diversification value there, so I wouldn't ignore it.
So lastly, Russ, a few equity funds made that top 10 list. What would you say investors who are looking at higher yielding equity funds, what should they be paying attention to when they're evaluating these funds for their portfolios?
Oh, yeah, I think it's really important to find a good manager and strategy when you're looking at equity income, because simply buying based on yield could lead you to some really high risk strategies. So you really want a fund that's well run and not taking on too much risk, has a good diversified portfolio, isn't leaning too heavily on, say, energy or utilities. But if you do all that, you can find some really good funds. And because value has lagged, you can actually get a pretty decent yield too.
Well, Russ, thank you so much for this very valuable perspective today on high yield investing in this tough, low yielding market. We appreciate your time.
You're welcome.
I'm Susan Jabinski with Morningstar. Thank you for tuning in.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.